I'm watching systematically a system breakdown where the rich are getting richer and the poor are getting poorer. And it is no individual's fault. It's the fault of a system that has been poorly designed and poorly run, right? And that is unfortunate because, you know, I think everyone has a right to a life of freedom, choice, and abundance. I think everyone should have the ability to build wealth and create wealth and to be able to create the life that they truly deserve. I don't think anyone should feel like their future is going to be worse than their present. Their future should be better than their present. But unfortunately, due to a system that is rampant and out of control, it's getting harder and harder to get on the ladder.
Hello and welcome. You're listening to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. Joining me once again, Goose is back. How are you, Goose?
Hey, Emil, how are you?
Good, thank you. We had you on a couple of weeks ago, about a month ago. We had you on, and you were, in your words, pissed off. So I think we should probably issue the same. Yeah. Well, is that good or bad?
Well, I mean, it's neither good nor bad. I mean, it just is. The reason I'm pissed off is because, like I mentioned in the last episode, I'm watching systematically a system breakdown where the rich are getting richer and the poor are getting poorer. And it is no individual's fault. It's the fault of a system that has been poorly designed and poorly run, right? And that is unfortunate because, you know, I think everyone has a right to a life of freedom, choice, and abundance. I think everyone should have the ability to build wealth and create wealth and to be able to create the life that they truly deserve. I don't think anyone should feel like their future is going to be worse than their present. Their future should be better than their present. But unfortunately, due to a system that is rampant and out of control, it's getting harder and harder to get on the ladder. Now, the problem fundamentally starts with money. The problem starts because we have a broken money system. Now, because we've got broken money, people's money, their cash, loses value rapidly. So money should have three attributes: a store of value, medium of exchange, and a unit of account. But if it's not a store of value, what happens is that as people earn money, which is effectively trading units of energy for tradable tokens, which is effectively what it is. You go and spend an hour chopping wood in exchange for $20 an hour. That's $20 an hour as a representation of the amount of energy you've spent chopping that wood. You store that so you can spend that energy somewhere else. That's effectively what it is, a transfer of energy, tokenized energy. The problem is, if your energy is not going to be worth as much in the future as it is today, you're forced to find ways to try and get financially ahead, economically ahead, which means that you need to invest. And if safe investments become harder to invest in because the system drives price inflation, then you're forced to progressively walk further and further out the risk curve. All investments are risk, right? Everything that is not simply holding your money. Like once upon a time, you would be able to earn, work and save. And let's say you saved, 10% of your money every year, put it in a bank account. If it didn't deflate in value, right? If there wasn't an inflation of the money supply. So for example, if we go back to, there's been several times in history, for example, in the Renaissance period in Florence, the florin didn't get inflated for 350 years. It was a sound form of money. You were able to keep that value for a long period of time. You could save up for your retirement. Now, everyone kind of knows that unless they invest, they're never going to be able to save enough to retire. Well, why is that? Why is it that when you kind of intrinsically know that if you get to retirement, you're never going to have enough money, you need to try and find some kind of investment? Why is that? It's because our monetary system is broken. Now, there's a quote from Henry Ford that I want to kick things off with. And he said, "It is well enough that the people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning." And I actually think that we're walking towards that now.
I think we are. Now, you've mentioned basically because we live in a society that promotes inflation, we're sold this myth. We're sold, well, we need to keep on producing more money to keep up with the rate of production. I don't believe that's true. A lot of economists, especially people from the Austrian School of Economics, when we say Austrian, there are a lot of different economic theories. Austrian economic theory is one of them. Doesn't necessarily mean I'm not Austrian by any means. They do not believe in monetary expansion to keep up with production. It's a myth. When you compare the lifestyles that people have in Australia, New Zealand, America with, as many people listening to this podcast may know, I live in Japan. We haven't had inflation basically from 2001 when I first got here through until about 2-3 years ago, until COVID hit. We didn't have any inflation. And anybody looking at the Japanese economy, all you've heard is how terrible it is in the media, everywhere. Because the way we look at economies, the way that economists have a look and try to assess whether an economy is doing well or not, all comes down to these really kind of dodgy measures that they use, like GDP and recessions and things like this, which are all about measuring growth in dollar value. Well, if you're printing more and more dollars, you're always going to have more growth. And so I have a mother and I have a mother-in-law. My mother-in-law, who is Japanese, has been able to do exactly what you said, save 10% every year, reach retirement age, and then that money is still just as valuable as it was. Well, maybe not just now because there has been inflation due to COVID, but before that, she could save. My mother, on the other hand, who lives in Brisbane, she is coming up on 74. She'll be 74 years old this year. She needs to think about asset allocation. And like, why should a 74-year-old who's worked her whole life have to think about asset allocation just to survive? Right? It's not to go and buy a Porsche or a yacht or anything like that. It's just to survive in Brisbane.
Yeah, it's unreal, right? And so it wasn't always this way. This is the thing. It's like we all assume that this is how it's always been. But the entire reason that the government needs to have a pension system and the whole reason the superannuation system exists in Australia and all of this kind of stuff is because fundamentally we don't have a money that will actually store its value over time because the monetary supply keeps getting inflated. Now, just as a bit of a recap on that, if you didn't listen to the last episode, the very simple way to think about inflation is not that prices go up. It's that more money gets printed and therefore the purchasing power of every dollar you have goes down. So now if in the case of Australia, right, if you take all of the assets in Australia, including all of the products, all of the mineral or everything like that, and if you divide it up by the amount of units of currency we have, that's going to give you a representation of the value of the dollar. If you print 20% more dollars, but the number of products and assets and stuff in the whole country hasn't changed, all you've done is you've devalued the dollar by 20%, and optically, the value of those assets will go up by 20%, very, 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 very broadly. And so you've really got to start, and it's a big issue, right? Because we start actually to go into this doom loop of that, like we actually have to fund a future where our elderly can't afford retirement. So then we have to fund that, which then increases government spending, which then means that the government needs to increase national debts to be able to pay for this, but all of this kind of stuff. And we start to fly into a doom loop of debt expansion and monetary creation. Now, before we kind of go into that, because I really want to talk about liquidity, right? I really want to, because I've been doing a lot of looking into this lately, and I actually think it's far more.
Before you do, what you just described does sound to me exactly like a Ponzi scheme.
Yeah. I try and avoid saying things like that because people then start to go, this just sounds a little bit, but it is, let me put it this way. Infinite growth makes perfect sense as long as you have infinite growth. So if the premise of your economic system is based on the fact that we will continue to grow forever, and in line with that growth, we can continue to grow money supply forever, as long as you keep growing forever, then you can make that mathematically make sense. The problem is if something changes in that spectrum, that means you don't grow at the same rate or in the same way. So, for example, we have declining birth rates, not a declining population. We have declining birth rates, which means that not as many people are getting born each year, right? Which means that we have, and population makes up such a huge part of the GDP that we actually have a downward pressure on that side of things. We have productivity improvements, which are actually putting downward pressure on inflation. So we have all these kind of things that are actually forcing against a system, which is actually what is causing it to be in a situation where the only solution is to create more debt in order to increase the money supply, in order to pay for all the things we need to pay for that we can't afford to have. So as a little bit of a context, Australia's total debt to GDP is about 260%.
Okay, let's clarify that. That's total debt. That's not, normally people are used to hearing a figure like 26% or 42%, I think it is at the moment, of the government debt to GDP. You're talking about total debt.
Yeah, total debt. I think you need to consider total debt because the reason you need to consider total debt is because we live in a debt-based monetary system whereby new money is created into existence through the creation of debt and credit. And so as we increase, so for example, if you go and get a mortgage, what happens is effectively new money is created because you're creating a credit note for the amount of value that you're getting the loan for. And so if you consider total GDP, that includes private debt as well. So homeowners, car loans, all of that kind of stuff, that contributes to basically the amount of like total money sloshing around in the system that is not, that is not fungible in that sense, right? So I always like to think about it in that way, because if you think about the GDP of Australia is about $6.734 trillion. That's a GDP. If we've got, Australia's GDP is about $2.59 trillion. And if we've got 260% total debt to GDP ratio, that means we've got about $6.734 trillion of debt flying around in the system. Now, what that does is that creates more money to fly around in the system. What does that do? That money, so if I take out a $100,000 loan and I go spend $10,000 at 10 different shops, what are they going to do? They're like, oh, wow, we've just made $10,000. What happens then? They go then spend some of that money. They go buy a new car or whatever. So what happens then? So money keeps flowing around the economy and eventually always ends up in real assets. In Australia, it ends up primarily in the housing market, which is why we have so much upward pressure on the housing market.
So the housing market in Australia, I believe that the total value of the housing market is around about 7 trillion in US, which is about 10 trillion in Aussie dollars. And if the total debt in the country, it's about 70%. So it's like these properties, the property market, it's pretty much all debt, right? It's 60-70% of it's going to be debt, because just like the vast majority of that debt that you're talking about, that 260% of GDP, is going to be mortgages.
Yeah. A very significant portion of it in Australia is mortgages. There's different ratios in different countries. So, for example, in the US, I think private debt is less than government debt. In Australia, private debt is more than government debt, I think. So because we have such a high rate of mortgages in Australia. So the thing about this is, because at the moment, property prices are moving faster than I've ever seen them. They're not getting reported that way, by the way, because all of the indicators are looking backwards. But I can tell you from talking to our property team that in the 5 years that we've had this company, we haven't seen property prices move this fast. It is out of control. In fact, I would go as far as to say that by if everything keeps moving at the rate that it's going, by mid next year, you won't be able to buy. Well, let me rephrase that. By early next year, you won't be able to buy a house for less than $500,000 in the kind of place where you would want to buy a house anywhere, right? There might be an investment, and that's huge. That's huge because just 5 years ago we were buying properties for $250,000, and now and these are in investable suburbs, and now the likelihood is that by early next year you're not going to be able to get anything really for less than $500,000, which means you need to move to units and all this kind of stuff and start to change the dynamic of the makeup.
This really speaks to the mission that we have at Dashdot. It's no secret that the best way to accumulate wealth is to be in assets that are growing faster than the rate of inflation, and therefore your wealth keeps on getting bigger and bigger and bigger. Now, some people are over here already, right? They have good capital, they have good cash flow, and that capital keeps on going up, and so then they can reinvest. And so if you've got 3 properties, it's not that hard to get a 4th. But if you have 0 properties, it's really hard to get into that first one. And what we're trying to do at Dashdot is not help the haves get their 6th, 7th, 8th, 10th property. We do that.
Yeah, of course.
But
yeah,
what's
we can still help those. There's nothing
important,
wrong. Yeah, so I just want to make a point there. A lot of people think that it's bad for rich people to make more money, right? I don't think it is. I don't think it's bad for anyone to make more money. I just don't think that people should be disadvantaged, or that there should be a structural system in place that is actually forcing it to be harder and harder unless you're already on the ladder. So I've got no problem with someone who's got a $10 million net worth working out how to generate another $10 million net worth. Great, have at it. Good on you. You got 10 properties and you want to buy another 10? Fine, all good. No problem. Intrinsically, no problem. The issue that we have is that we've got a system that is making it harder and harder and harder for people who don't already have assets to go and get assets. And the problem is that it all comes from a broken money system. Because our money doesn't hold any value, and because of increases in liquidity, which I want to talk about in a second, because this is the thing that underpins everything. Because of increases in liquidity, money flows into the economy. It flows into hard assets. Flows into hard assets because people realize either implicitly or explicitly that their money is not going to be worth more in the future. So they need to find assets that will help them to preserve their wealth and ostensibly increase their wealth, but it may actually just be trying to preserve the value of their wealth over time. And so all the money flows into these assets. And the problem with that is that those values go up wages aren't increasing at the same rate, which means that year on year, it gets harder and harder and harder to buy assets, which are going to be able to store your wealth. And so what happens is that, for lack of a better term, the poor get poorer and the rich get richer, which seems like it's unfair. And it seems like it's easy to blame these people that have built wealth and go, well, it's your fault. You're stealing from all of the other people. That's not true at all. What's actually happening is that they aren't just doing their best to try and set up their future, just like everybody else is. And so you have a choice to be able to get on or get off the wagon, but you can't sit there and shake your fist and shout at the sky. You've got to understand the system so you can work out how to play the game.
And speaking to our mission then at Dashdot, and I know this is really important to you, it's not about necessarily helping the haves accumulate more and more. It's about trying to get more people from looking down the barrel of a life of have-not and poverty, getting them into the hard assets. And in order to do that, the education piece and explaining how this works.
This is why I'm pissed off, because it is getting exponentially harder for people to get on the ladder. And that is a problem. Like, that is a problem because that means more and more people are getting left behind, and most people aren't even aware of it. And they don't even realize how important it is to take action now, because it's going to, like last episode we covered it, it's getting compounding 12% harder each year, which basically means in 6 years it's going to be twice as hard.
Well, I just recorded a fantastic podcast with Sam Kritsatakis, who is our sales manager. And by the time you're listening to this is the previous episode to this one, right? It's the one that we did last week. And in that episode, we broke down a bunch of strategies, some creative strategies, some ideas that people may not have looked at in terms of how do I get into my first property or my next property, because that hurdle's getting bigger and bigger. And I think this generation, like I'm 47 years old, kind of fortunate in that I haven't had to sacrifice in order to be able to get ahead financially by investing in property. If you're between 20 and 35 now, it's a lot tougher, and it's getting more and more and more difficult. And there are tough decisions that people have to make around what am I prepared to sacrifice now for my future? Like rent vesting and these other ideas. That's a bad example because rent vesting isn't necessarily a sacrifice. If you do it right, that can be
a great way to go.
Worlds.
But the reason you need to rent vest is because of the system it being the way it is. When I was younger, and my brother had, I think he was maybe 18 or 19, and I'm 2 years younger than him. So, I was still living at home, and he had only recently left school, and he was working on a farm or something, like nothing particularly. He wasn't in some high flying corporate career. He was looking to buy a house. We grew up in a regional part of Victoria near a town called Terrelgan, which a lot of people would probably know because the property market there went off pretty well. But he was about to buy a property in Terrelgan at like 19 years old, working on a farm. Now that whole idea, someone just out of school, someone who's under the age of 23, working in a normal job, all right, I'll just go buy a house without any like huge amount of effort. It's not completely gone, but it's broadly gone. There are still young people who are making a good go of it, but it's getting harder and harder to do it. And so I want to shift a little bit to talk about liquidity, because it's all well and good to keep talking about the problem, but I think people need to understand, why is this a problem, right? And so there's an investor, his name is Stanley Druckenmiller. He is often referred to as being one of the great investors of all time. Like, he's in the same category as, Warren Buffett and Ray Dalio and all of that kind of stuff. Some people say he's the best of all time. His fund for 30 or 40 years straight, I think it was 40 years straight, never had a single year where they recorded a loss. And there was only 4 quarters where they recorded a loss in 40 years. And the average annual returns were 30% a year for 40 years straight. Now, what's interesting about that is, so those are pretty wild returns. So
those are good numbers.
There's pretty bloody good numbers, right? So he obviously knows something. He obviously has worked something out. Now, what's interesting is if you look at Stanley Druckenmiller's backstory, he actually trained or was kind of mentored by George Soros. And early in his career, he was an analyst, and he was analyzing stocks or whatever. And he got this meeting with George. He'd been doing all this work on a particular stock or whatever, an investment. He'd done all the fundamental analysis. He'd done all this kind of stuff. And he had his first big shot where he was going to present it to George Soros, who he's a billionaire. A lot of people think he's super evil. I don't really have an opinion on that. But anyway, he had this opportunity to present this case. And he went in there and he presented his case of why this should be a great investment and all this fundamental analysis. And George Soros turned to him and said, that's all well and good, but what makes the stock price move? Which is a very interesting question. And Stanley Druckenmiller didn't have a good answer for it at that point. And so he said, well, go away and you come back to me when you tell me if you know, once you know what makes the stock price move. And so he went and did a whole bunch of research. And what he worked out was the stock price moves when there's more money flowing into the system. And so he then basically based his entire career on understanding how liquidity affects different markets in different ways and where is the money going to flow to and why. Now he started his own hedge fund in 1986 and he had that, and he's been doing it ever since. So it's 30 odd years since then. Now what's interesting about that is if you can understand liquidity, everything else starts to make a lot of sense. Now liquidity is generated in several different ways. So during COVID, everyone kind of probably started hearing about for the first time quantitative easing, which is basically they started printing money, which we talked about in the last episode that we did. It's not actually printing money, it's just typing in more zeros into the machine, right? But everyone thinks it's this kind of systematic printing of money. But there's lots of different ways that you can increase liquidity. So you can increase credit. So as debts increase, that increases liquidity. You can decrease reserve requirements in banks. That increases liquidity. You can, through grants and different ways, different funding projects from the government, increase liquidity. So fiscal spending, i.e. funding more projects, that can increase liquidity.
So all of these things are increasing the amount of money supply, right? So
Correct.
This is inflation. Okay.
Yeah, they're increasing the amount of money supply. But what's interesting about this is it's not just a national phenomenon. So it's not just like if Australia prints more money through any of these mechanisms and a myriad other ways that they can increase the money supply, then that affects Australia. You actually have to look at global liquidity. You have to actually look at what's happening all around the world and how that might move around is actually the most interesting thing. So global liquidity has been going up tremendously over the last decade. I mean, since over the last 2 years, it's increased by over 5% a year. And we're talking about global money supply, that's a lot of money. Now, what happens is that then moves around to ideal different locations. So, for example, if interest rates go up in Australia and go down in the US, what's going to happen? More money will flow into Australia because people are going to be chasing yields on treasuries. So international capital flows into the Australian market. That increases liquidity in that way. Now, so the point here being it's not just a national phenomenon where the Australian government goes and prints money. We have this global phenomenon where as money supply increases globally and we have global trade, then money can flow into and out of countries, right? So you have external supplies of money coming in as well as internal mechanisms that drive liquidity up. Now, as money floats around in the system, it seeks to find a good home where people can find a risk-adjusted return on their capital because the money is no good and it's devaluing in a bank. Now, in Australia, particularly, that the primary asset that people seek is real estate. So there's been a long-held belief that interest rates go up, house prices go down. Right, that's been a long-held belief. Now, we did a study a couple of years ago to prove that fundamentally there's basically there's such a low correlation between interest rates and house prices that it's not even something that you should use as a realistic metric. But what's interesting to think about is, so if interest rates have gone up, they went up 12 times or whatever in 18 months or whatever the number was, interest rates have gone up a lot. So cost of debt has gone up a lot. Now, we could argue that it's at a normal level compared, tracked historically. Nonetheless, it did go up a lot. Yet house prices are actually moving up faster than we've probably ever seen them. So why is that? And why isn't this function of increasing interest rates? Because the increasing of interest rates by a government is specifically designed to lower spending. The idea being that if they can increase interest rates, they'll decrease borrowing because the cost of debt is higher, so less people will want to borrow. Therefore, that'll decrease the flow of money around in a system, therefore slowing the economy down. That's the idea.
This is what we're told all of the time in the news. And the media will say, oh, yeah, the RBA is looking to reduce interest rates because inflation is now under control. And and interest rates are constantly tied to inflation in the media and in all of that news.
Yeah, totally. But so now that may have been true once upon a time, but it isn't true anymore. So once upon a time, if your economy was moving too quickly, right, and you had too much growth too quickly, and prices were starting to get out of control, and there was too much prosperity, and it was becoming bad for the system, you could increase interest rates to cool your economy down, to slow it down. And if you wanted to speed your economy up, you could decrease interest rates to increase the access to capital, which is going to increase money flowing around the system, liquidity, And as you increase the liquidity, what does that do? It increases spending and increases the amount of money going into assets. People get wealthier, all of this kind of stuff, right? So this is the basic premise around interest rates go up, economy slows down, interest rates go down, economy speeds up. Now, that may have been true once upon a time when you had, say, total debt to GDP ratios of, let's say, 20%. Because at that level, you can on the portion of the economy that is debt-based, you can slow down the expansion of credit. But the problem is when you've got, let's just say, 100% debt to GDP ratio, one person's liability is another person's asset. So if the Australian economy is 2.6 trillion, and let's just say we had a 100% debt to GDP ratio, we actually have 260%. Then if we increased interest rates by 1%, then we would be increasing the payments on that debt by 1% of the total GDP. That's assuming that all of the debts were variable rate, right? Which they're not, but we can come back to that. Now, that is huge for the transfer of money and the increase in liquidity in the system, because a lot of that is government debt, so they have to increase spending to be able to pay off those interests and all of that kind of stuff. And also, some people out there are receiving more capital. So who are those people? Typically asset holders, because typically those profits or the increase in capital that's generated on that debt is going to flow through to businesses and banks. That gets distributed as dividends to shareholders, asset holders. They then go spend that on more assets. So you end up with this cycle that keeps taking away and pushing more and more into assets.
This feels like a good moment for me to check my understanding of exactly what you're saying so that I've got this right. Essentially, let's say that I'm a lender, you're a borrower. I give you $100,000 to go and invest, and so that gets created at that point. And let's say that the interest rate, for argument's sake, is 5%. So you need to give me $5,000 per year. Then there's an interest rate hike, and it's gone up by 1%. You don't have to give me $5,000 a year anymore. Now you have to give me the $5,000 plus 1%, which is $6,000. Now, what you're giving me, right? It's like one person's debt is another person's asset, as you said, right? You're now giving me, instead of $5,000 to play with, I've now got $6,000. So now I can go and spend $6,000 somewhere. And so by increasing the interest rates, you're actually increasing the amount of money that's in the system.
Correct. And a decent portion of that is government debt, not all of it. But even on private debt, that still is flowing to people who are then that increases the amount of money that's flying around in the system. Okay. Now to some degree, not all loans are variable. So that's not absolutely true, but it's a good mental exercise. And also, sometimes in that equation, you're just taking money from one place in the economy and pushing it into another part of the economy, but that still changes the equation, right? Because you still have people who have got car loans and student loans and all of this other kind of stuff, that's still money that's floating around in the system, right? And so what that does,
spending.
Yeah, exactly. It increases spending somewhere. Particularly on government debts, because what they do to finance that is they effectively just have to issue more money and go more into debt to be able to issue to be able to pay the interest on those debts. So if you then start to understand that, and you might start to understand the fact that, okay, liquidity, money moving around the system, is far more likely to increase asset prices, and then increasing interest rates increases someone's income, then you can understand how increasing interest rates, particularly when you have a 260% debt to GDP ratio, can increase liquidity of people who are able to buy more of the assets. So as interest rates go up, people are spending more and more money to go and buy more and more of the assets. Now, that's going to continue to drive the market. Now, what happens is you have then market reflexivity. So then you've got all these other people going, shit, property prices are going up. I've got to get in now. So I'm not saying that every mum and dad in Australia is suddenly collecting more interest on debt. What I'm saying is that is going to drive property prices. People see property prices going up. They realize they need to get in now or it's going to be too late. It starts to flywheel and flywheel and flywheel. And that's what we're seeing happening right now. Now, the unfortunate thing is there's not a clear end to this.
Yeah, that was the terrifying thought as you were saying that I had. Like, okay, you have low interest rates, property prices go up because easy access to credit. Interest rates go up. That means that things cost a little bit more, but one person's spending is another person's income. And so we have the loop continuing again. How do we stop property prices from spiraling out of control?
Well, I don't know is actually the short answer. Now, what's interesting about that, and so I want to be pretty careful here because I don't want to try and incite panic. amongst anyone, because we don't know what the future holds. So, this is all hypothetical. You really do need to think like, what's the end state? Now, I don't believe that the end state is a market crash, right? Because you could easily start to then form an opinion where it's like, is this a bubble? Is this a housing bubble? Does that mean that property prices are going to go up and then crash? But I don't actually think that it is that. Like people think about a crash, they think about like 2008 in the US where like house prices crashed, or they think about the dot-com bust where, the stock market crashed. You think about all these things, and you think about a crash in the form of the values of things going down, and that is bad. But I actually don't believe that that's the situation we're in. And the reason I don't believe that that's the situation we're in is because what governments have been proving to do over the past 20, 30 years is that when there's economic trouble, they hit the printer. Now, we could go way back on this specific topic. I mean, World War I was supposed to be the August Weekend War. It was supposed to be the August Weekend War, and the British. And this is really the first time in modern history where this is where the fiat system really came into play in modern history. Is when the British went to fight the Germans, or the Hungaro-Austrian War, or whatever it was. It was supposed to be over and done in a weekend, and then it dragged on, and then they ran out of treasury reserves, and so and nobody wanted to buy UK government bonds, British government bonds, which is how they would have raised capital. And so someone went, hang on a second, the money printer's right there. We could just print more of the money. And wow, that's an interesting idea.
Yes. And Keynes said, this is brilliant. Afterwards, he said, what a clever idea, right? Yeah. The person whose economic theory has become the foundation for pretty much the way all monetary policy is run in every Western government, apart from Japan, if you call that Western, over the last century, has come from a guy who was really pleased about how much they'd managed to rip off the population.
Yeah, so it was pretty crazy, right? Because the UK was the dominant empire. They had the global reserve currency at that point in time, and then during World War I, they basically devalued their currency by, don't quote me on this, but like 50% or something like that. And as a result, weakened their currency, and that started the decline of the British pound being the global reserve currency. Eventually got replaced by the US dollar over time. But and we could spend hours talking about monetary history, and it's all very fun. But what's interesting is if you just take a look at more recent modern history, if you go back to the dot-com bust, that was the first time that there was easing really starting to get applied, and they started throwing money around in the system. Then 2008, the GFC happened, and everyone, right, money printers on, let's go. The solution to this is to push more money into the system. And it worked. Now, the big issue, they were like, oh my God, if we don't stop this, we're going to end up with the Great Depression. And no one wanted that. They were like, the pain is too great. You know what we'll do? We'll just hit the printer. Now, as a bit of a refresh, by the way, for anyone who hasn't yet listened to the last episode, every time they hit the money printer, every time they increase the money supply, they're stealing money from you. So if the money supply increases by 10% a year, that's 10% of your savings, not your income. It's not your income tax rate. It's your savings are getting taxed by 10% a year, and your wages are going down by 10% a year unless you get a pay rise, right? So every time they increase the money supply, they're stealing from you. But in 2008, they hit the money printer and they went, oh, look, that worked. We managed to get out of this without a Great Depression. It was a little bit uncomfortable, but hey ho, life's good. And then we truck on through to COVID, and the shit hit the fan again, and they went, oh, money printer. Okay, and basically we were all good. So now you've got this situation where it's like the learned behavior of governments is crisis, print. And so the likelihood of us getting to some kind of like crash point where we're going to have some kind of major systemic failure is pretty low. In fact, if you look at all of the metrics over the last couple of years, we should have gone into a recession over the last couple of years. If you segment the data a little bit more clearly, you can actually find that we did go into a kind of a rolling recession in parts of the economy at different points in time, which were propped up systematically by increases of liquidity in those pockets over time. This is how we managed to just skirt out through a recession. And so if we then think about what might happen is, is it reasonable for us to be able to have a system that continues to, the cost of debt continues to increase, the amount of debt continues to increase. We start to go into this kind of spiral of money flying into the assets. Is that reasonable that we should find a limit to that? Yes, it is reasonable that we should find a limit to that. But what should we reasonably expect based on, all of the examples that we can see recently is going to happen is that when something goes wrong, they'll hit the money printer again. And that will probably work. That will probably stop people hurting really, really badly. But what's likely to happen is we're just going to effectively inflate everyone into poverty, because effectively all you're going to do is you're going to keep driving asset prices up. You're going to keep driving nominal purchasing power down, which means that your loaf of bread, which was 50 cents 20 years ago, and whatever it is, $5 today or whatever it is, it's going to be $10 or $15 in 10 years' time. This is what's going to happen. This is what I think is going to happen. So I don't think we're going to hit a crash. I actually think that what's going to happen is that because house prices are mostly only increasing in nominal price, which is like optical value, not actual value, what's happening is our purchasing power is going down. It's likely that the housing market will continue to go up over the long term, because the answer will be to print more money, which will drive asset prices up. Now, what that's going to do is that's going to increase the divide between the haves and the have-nots. That's the problem.
That's the real problem that no one's talking about.
This is the problem when
people talk about. Yeah, it's things are bad in the property market if you're not a property investor already, or if you're not a property owner already. We're told by economists that we need to be worried. Like you mentioned a recession before, and all of these metrics we're told that we need to be worried about. Like, oh yeah, there was nearly a recession. A recession. I'm kind of like, so what? It's based on metrics that I don't think are actually very useful for measuring the health of an economy.
No.
Right? Technically, a recession is 2 consecutive quarters of negative growth. So what does that mean? Well, if things contract a little bit, is it necessarily that bad? Okay, you don't have as many customers, but you don't have as many outgoings either. Mm. It's not like someone comes along and burns the store down or whatever it is.
But you know what is a sign of a bad economy? You know what is a sign of a bad economy? Not whether we have negative GDP growth for 2 quarters. It's whether people can afford to live the life, like whether they can afford the same standard of living that they could afford 2 or 3 years ago. If they can't, that's bad. There's no clear term for that. Everyone's just like, oh no, it's fine. The economy, the GDP looks good. It's like, what?
This again comes back to my fascinating case study of people looking at the quality of life in Japan versus the quality of life in Australia.
Yeah.
And I've had arguments with friends of mine, and then they come and they visit Japan, and it's like, no, Japan's my favorite country now.
Yeah.
They can't move over there because they've got family and things like that. But the way things work in Japan, where you don't have this inflation, and so you don't have an ever-increasing divide between rich and poor, and you don't have affordability crises, or like this notion of an affordability crisis, cost of living going up and up and up all the time. You don't have that. Now, this whole inflationary system can provide a pretty good quality of life, because you basically can bring forward the joy that you might have later, right? You can essentially, when you're taking out debt, you're saying, I'm going to earn less now than what I spend. And spending's fun. So you can buy stuff, you can import stuff from other countries, you can improve your quality of life. But eventually, you have to pay that back at some point. And the way that the monetary system deals with paying that back advantages some people in society a hell of a lot more than others. And so we have this divide happening. And that's the real thing to be worried about. Don't be worried about inflation. Don't be worried about a recession.
No.
Be worried about the affordability and whether or not you're going to be able to live that life. Whereas in Japan, everyone can get a house.
Yeah.
Right? If you've got a job, you can afford a property somewhere. Right? Property prices are not astronomical or crazy. They were, and they were going absolutely crazy in the late 80s up until 1990, but somebody worked out, all right, we're going to go to a non-inflationary system, and they kept it like that for 30 years until COVID hit, and the quality of life in Japan is absolutely spectacular.
Yeah, exactly. So it can be done, right? And so, the issue here is that, if we follow that train of thought, some people are sitting there going, oh, the market seems pretty hot right now. What I'll do is I'll wait. So I don't think waiting is going to actually get you anywhere. I think waiting is only going to make life harder for yourself. And the reason for that is monetary inflation. Now, the thing is about this as well is debt in an inflation. If you can take on debt in an inflationary environment, you actually can get rich faster because the value of your debt deflates. Right? So they're deflated because the governments are deflating their own debt by increasing the money supply. I was thinking about this in the US. The US total debt to GDP is about 750% roughly. So that's out of control, and it's kind of like there's a lot of questions. Is the US going to go bankrupt? Like, are they going to default on their debts? It's like, well, they own the money printer. So if I owed $100 million in debt, and I had a money printer, and the person was saying, "Give me $100 million," and I didn't have $100 million, and I had a money printer, I'd print. I'd be like, "Oh, what you want? Oh, you want dollars? I've got the machine that makes them. Here you go. Just have some of the dollars. Print." right? So they print away all of their debts, right? But in doing so, they print away all of your debt. There's this great story about, have you ever heard of the richest man in Weimar, Germany? Hugo Stinnes. So Hugo Stinnes.
Not that I can recall.
So
it's one of those ones, probably, but my recall's not great.
So Germany was formerly called the Weimar Republic, and they had hyperinflation. Now, hyperinflation is, I think, there's different definitions of it. I've heard 50% increase in prices or increase in money supply every month, or I've heard triple digits in a year, but basically it's lots. At one point, a loaf of bread cost 200 billion Deutschmarks in Germany, where it used to, at one point, it was like $1. In Zimbabwe, they also had hyperinflation at one point, and they had to print $1 trillion notes. Now, I'm not suggesting, by the way, that Australia is going to go into hyperinflation. I think that that's a scary thought, and I actually just don't. Actually, you can have inflation without it being hyperinflation and still have it being very bad. If inflation gets to 20% a year, that's 20% of your spending power each year that gets. I mean, that's bad, right? It doesn't need to be hyperinflation. And I don't necessarily think we're going to get hyperinflation, so I'm not trying to beat that drum, and I'm not trying to drum up kind of fear around that either. But what's interesting is Hugo Stinnes saw this happening. He was smart enough to see it happening, and so he basically borrowed as much as he could. His family owned a coal mine, and so he had a little bit of capital to start with, right? But he went and took all the debt that he could and started buying all these hard assets. So he started buying cargo ships to transport the coal. He started building railways and all of this kind of stuff, and started putting it into all these real hard assets that are actually going to increase. And then the value of his debt just collapsed under hyperinflation, but he was left with all these hard assets where prices were going up. So he was actually collecting the increased prices on all of the stuff and saving all that money. And so he ended up being the richest. They called him the richest man in Germany, Hugo Stinnes. And it's a really great case for why, if you intelligently use debt to buy hard assets, so don't use debt to go and buy a car, which is a depreciating asset. Don't use debt to go and buy some clothes because you can't afford them now, but you really want to get some nice clothes before you go to a party. Don't do any of that kind of stuff because that's dumb. But using debt on Australian real estate is really, really smart. Now, I just want to segue this a little bit because this is really, really important. So we established in the last episode that on average, the money supply in Australia has increased by about 11.4% a year since 1965, right? So that's a long track record. And so if we just use that at face value, what you need to do is, and there's a couple of other metrics we threw in there in the last episode as well, but basically you've got a 12 to 15% hurdle rate once you factor in other inflationary measures as well. You've got a 12 to 15% hurdle rate that you need to beat in order to be able to preserve your capital or to start to actually improve your wealth position. Now, how are you going to find? Let's call it a 15%. Let's call it 15%. That's the target that you need to earn on your capital. How are you going to get 15%? You're going to go put it in the stock market, in an index fund or something like that? Well, no, you're probably going to get about 8%. Now, on average, very generalized term here, Australian property increases by about 8% a year as well. Why is that? Okay, because it's being stimulated by the same monetary supply increase that's stimulating the stock market. But here's the thing: if you bought a property for $500,000 and all of the cash you had to put into the deal was $100,000, so you probably got an 85% LVR, 88% LVR loan, plus you got stamp duties, plus you got conveyances, you got all that kind of stuff. Let's just call it $100,000 into the deal, which is in total 20%. But we'll say that captures all of the costs of the deal. This is just to simplify it. If the property increased by 8% a year, the property value would go from $500,000 to $540,000 in 1 year. So that's a $40,000 increase in the value. But because you've only put $100,000 into the deal, you're going to make 40% of your capital back in that, right? So you'll have a 40% return on investment, return on capital. Over 10 years, you will generate an additional 579% return on invested capital over that period of time. So you're basically going to be outstripping the rate of inflation simply by doing that. Now, the real reason you're doing that is not because property prices go up by 8%. The real reason you're doing that is because you've got 80 to 90% debt on that property, which is inflating your returns. Now, the reason Australian real estate is so good is because it's so bloody stable and safe. Like, I don't think there's going to be a real estate crash anytime soon. I can see no fundamental reason why that would be the case. There's no systemic reason that we could expect to see a property market crash anytime soon. And so on the basis that the asset stays safe and stable and continues to grow, it's one of the best ways you can accelerate your capital if you want to actually try and get ahead. And that's why you need to start now, because $500,000 properties might not be available in 2 years' time. So if you're sitting on your hands going, I'll come back to this later, you just might not be able to. So there's a real strong incentive for people to start to take action if they don't want to be left behind.
And this is how the haves end up becoming have more and more and more, because it all comes down to that access to debt. If you can get debt, then it's not very difficult just to leverage up, right? If you already have two investment properties, it's not that difficult just to wait 6 months. You've got enough equity there. You can pull that out, invest it into another one. And this is how the rich get richer. It's not because they're ripping everyone off. It's because we have a broken monetary system, as you said at the top of the program. We have a broken monetary system that unfairly advantages those people. Now, we didn't make that system, but I'm kind of reminded of something Tony Robbins says. Tony Robbins, I know, controversial. He's polarizing. Some people love him. Some people hate him. But he does say one thing when you go to a seminar. He goes, he's up there and he says, everyone in this room has what they deserve. And, he's not talking about someone who's just been diagnosed as terminally ill with a rare disease or something like that. He's talking about your financial position. Now, I would challenge anybody to find a better country than Australia than being able to create your own destiny regardless of the circumstances under which you're born. There are so many support systems. There are so many ways for people. Now, I know that it's going to be tough for some, right? If you're born in a broken home with lots of drugs around and things like that, that can be a tough situation to climb out of. But it's probably going to be better in Australia than it would be in any other country in the entire world. More than any other, I believe, absolutely hand on heart, even more than New Zealand, where I'm from, you can make it if you make the right decisions. And that's really what it comes down to. So you don't get to choose whether or not you're born rich or poor. But I firmly believe everyone in Australia has a choice of whether or not they want to die rich or poor when they're at the age of 80, 90, whatever it is. And it sort of comes down to what your mindset is. And I think this is the crux of it as well. There are some people listening to this who are going to go, actually, I understand the rules of the game now. I didn't before, but now I do. And now that I do, if I don't make it, that's on me. And they're going to do everything that they can. We talk to clients. We've had clients on the podcast as well who've gone through all kinds of transformations in terms of their lifestyle and the decisions that they're going to make so that they can provide for their own future. And as I also said in this program, it's tougher now than it used to be, but you know what the rules are now. You know what you have to do if you want to win. And if you don't want to win, that's okay, but that is on you, right?
Yeah, absolutely. And I think that's a really good point, because it's very easy to be like, well, it was easier for my parents, therefore this isn't fair. Therefore, I'm going to shake my fist and shout at the sky. Why is this unfair? Why isn't it as easy for me as it was for my parents to be able to get ahead? That's the wrong question, right? Because comparison is the thief of joy. You're not in that set of circumstance. They didn't do anything wrong, by the way. So everyone who blames boomers, and it's a complete fallacy. They didn't do anything wrong. They were just doing their thing. They were buying houses. They were doing everything that you want to do. Right?
It's like Henry Ford said, right? It's because they don't know. The boomers didn't know that the system was ripping everyone off. Most people listening to this
they're also suffering too. Can I just point out that they're also suffering as well? Everyone, like my parents, for example, sure, it was easier for them to get into the property market, right? But they're still retiring on a pension. They've got some super and all that kind of stuff. They're still going to retire on a pension. Why? Broken money. Not everyone has it good. And so, yes, it's going to be harder today than it was 20, 30 years ago. In fact, it's going to be harder today than it was 10 years ago. It's going to be harder today than it was 5 years ago, which means it's also going to be harder in a year's time. It's going to be harder in 2 years' time. It's going to be harder in 3 years' time. It's going to be harder every year moving forward. And so if you understand that, then you have choice. And if you have choice, you have control. And so you get to decide how you want to play this. Do you actually want to sit on your hands, complain, and then end up with nothing and end up not actually creating the life that you want? Or do you actually want to start to try and work out how to play the game? Now, yes, it might actually require you to get a little bit more creative. It might actually require you to work a little bit harder in the first instance. But as soon as you can get that first property under your belt, then you're set. You're off to the races. Gabby and I basically built our entire property portfolio off after we got the first one. All of the rest of the properties we bought through the so the second one was bought from the equity of the first one. The third one was bought from the equity of the first two. The fourth one was bought from the equity of those three, and so on and so forth. So it's like it's getting to number one. It's getting from 0 to 1 is the hardest. And so if you understand that, you should do everything you can to get there as fast as possible.
Because for the boomers, okay, they could get one easily, but then getting to two was a bit harder. Getting to three was a bit harder, right? But now you get one. The speed at which things are growing, it's not like the boomers where you have to wait around for 5 years before you've got enough equity to get into the second one. If you can get into one now, boom, you're off. You're pretty much one and done, right? You can just recycle the equity from the growth in the properties into the next one, into the next one, into the next one. How many boomers were able to buy one property per year 30 years ago? Not many.
Well, and the statistics back that up, right? The statistics back that up with 91% of property investors never get past the second property, right? And but certainly in today's age, it's a lot easier once you actually get started. That's for sure.
And we've had clients who didn't have any properties. They get one. A year later, they can get another. A year later, they can get another.
Yeah. So since we started Dashdot in 2019, well, we measured it over the first couple of years, and the average amount of time. So most property investors got zero properties, right? They're buying their first property. So we help a lot of people buy their first investment property, and on average, it would take people between 10 and 13 months to get their second property. Right, but in that range, depending on how quickly they went and got a loan, but based on their ability to take equity, which is huge, because if you can follow that trend, you can get 5 or 6 in 3 to 4 years, which is going to set you up, and then you're fine.
So there's a strong argument to say, okay, yeah, boomers did have it easier, but they didn't get the growth as fast as what you can get now. So it's harder to get in, but it's much harder to it's much easier to accelerate.
Yeah, I mean, I'm not 100% sure about whether it's an accurate statement to say they didn't get as much growth, but certainly, I think things like access to credit were a little bit harder as well.
That's what I mean.
So I think that we've had a pretty consistent trend of property prices increasing in line with money supply growth. So I think that's been pretty consistent. But the thing is, access to credit was a lot harder than it is today. It's access to credit has gotten easier and easier over the years. Why is that? Why is that? Because banks have got to try and work out how to freaking keep making money, right? And
the banks need to do that because the government has told them that they need to do that so that they can buy government bonds. And so government debt wasn't as high back in the 80s, right? When the boomers in the 70s and the 80s, when the boomers were buying these properties, the banks, the government didn't need tons and tons of cash, right? They were doing a reasonable job of managing things. And so lending criteria would be more stringent. Interest rates could be higher. And so like up in the 20%. 20% with low overall debt. It's a very, very good way of keeping inflation relatively under control. But then the environment that we're in now, suddenly that's completely flipped.
Yeah, exactly. And what's interesting about that is, going back to what I was saying earlier, is when the total debt to GDP is much smaller, interest rates have a greater ability to influence economic heating or cooling or speeding up or slowing down. And so when total debt to GDP was 20, 30, 40, 50%, higher interest rates really did keep the economy under control and did keep things moving along in the right direction. They had much more control over it. The problem is the government has to borrow money as well, right? So their spending starts to outstrip they spend more than they earn. So they're borrowing money too. They're borrowing that through the issuance of treasury bonds. They've got to pay interest on those bonds. Their cost of debt goes up, and it starts to go into this, if you were borrowing money to pay down debts, therefore increasing your debt, and then every time the debt came due, you borrowed more money to pay down the other debt, and then where does that put you in 10 or 20 or 30 years? It puts you in a pretty bad situation, right? Like, I think everyone intrinsically knows that. If you just went out and got a credit card to pay off another credit card and then got another credit card to pay off that credit card, and every time it was slightly more because you've got to pay the debt plus the interest, you get to a place where it gets pretty unhealthy pretty quick. You end up in like the US with like 750% debt to GDP. Globally, by the way, the global debt to GDP is about 350%. There's not enough money in the world to actually pay down all of the debt, which is pretty crazy. And so which specifically means that at some point they're going to need to print enough money to pay down that debt. Right? That's literally that's the only solution. When things are denominated in pieces of paper, it gets a little bit weird. Okay, so you need 100 million pieces of paper. Okay, I'll just cut some more pieces. You want some more pieces? Right, I've got some. No, here you go. Have some more pieces of paper. It's a really funny and strange system because the value of our money is is non-existent. Like it's not actually stitched to any kind of economic substance. There's no gold back. There's no nothing. And so this idea that things are denominated in something that doesn't have any value, pieces of paper, or even just digital numbers on a screen without any actual store of value, because you can print it up, is just so strange and weird, right? And this has been a big experiment, particularly since, obviously since 1913, 1914, when the UK started printing money and debased their own currency, but more specifically since 1971, when the US went off the gold standard and everyone just moved to a fiat system. It's been a very interesting experiment over the last 50 years or whatever it is. But it's an experiment that doesn't appear to work, right? If you go, there's a website called WTF happened in 1971, and I think everyone should go to that. Anyone listening to this should go to that website and just take a look at some of the graphs. And 1971 is when the US went off the gold standard, and the US is the global reserve currency, and so that their monetary policy basically is the world's monetary policy. And you can see what has happened since they went off the gold standards. You can see what has happened since governments all had unfettered ability to print more money as they saw fit to solve the problems they have. It'll all start to make a ton more sense. And once you understand that, and once you understand that asset prices are driven by liquidity, and the governments will continue to print more money to solve all the problems they have, and as they print more money, they're stealing the money from you, you realize a couple of things. You need to collect as much of those stupid bits of paper as you can and put them into hard assets as quickly as possible. That's the game. The real game is make fiat trash cash and then go put that into hard assets. And in Australia, the best returns, those returns I just mentioned there, you can get, if you get a 90%, 85 to 90% LVR loan on a property over 10 years time, growing at 8% average a year, you'll make whatever 590% return on invested capital in 10 years. That's bloody good.
And that's bang average for property, right? 8% per year, that's bang average. That's not relying on our AI or anything like that to pinpoint locations that are expected to grow a lot faster earlier and things like that. That's bang average. That's if you went to realestate.com.au and you chose a property at random. That's what
bingo.
I'm about.
Yeah, bingo. And that's the point that I wanted to make. Is like super, like on our clients, well, for the last 5 years, we've averaged 67% return on invested capital in the first 12 months, right? So if you can get 67% return on your invested capital in 12 months, go find a better, I'm sorry, where are you finding a better asset class? Can you, particularly on a risk adjusted basis, can you actually find a better investment? I don't think so, right? And so you've got an opportunity to get, I spoke about Stanley Druckenmiller earlier and how he's considered to be, the GOAT, particularly of macro investing, 30% a year that he's made. You can make 67% in 1 year. Obviously, that's not, it's not an income claim. It's like everyone's situation is different, but on average, that's what we've been able to get for our clients. You can get it. It's routinely available to you if you invest in the right locations and you have the right debt structure to be able to get several 100% return on invested capital in just a few years. And if you can do that, then you can get ahead. And that's the game you can play.
That is the whole game wrapped up. It's earn cash, get that cash into hard assets, use those hard assets to leverage and get debt, because the debt's going to get inflated away and the value of the asset is going to get inflated up. And so your debt's going to disappear, the value of the asset's going to go up and up and up, and you're going to be sitting pretty, and so many people are these days. But if you're listening to this, don't lose hope. Definitely don't lose hope. The property market, it does feel like it's a bit of a runaway train, but there is time to get on board if you take action pretty quickly. Our mission at Dashdot is to get as many people who are in the sort of have-not at the moment, where you don't have freedom, you don't have choice, you don't have abundance, over into the category of haves, because that's our mission. It's a good thing. It's societally, it's good. We're about helping people. We're not necessarily just about helping the haves expand their pot of gold and get a disproportionate amount of the value or the wealth that's in society, right?
Making money is not evil. I would argue that governments stealing your money from you is evil, and they're doing that. And you have an opportunity to fight against that. You have an opportunity to stake your own sovereign claim on your own future by protecting your own assets. And I think the more people we can help to avoid that theft of wealth that is happening through inflation, the better our society is going to be. The more you're going to be able to help other people. And so that's really what it's all about.
All right. Well, that feels like a very good note on which to say thank you very much, Goose. It's been
My
a
pleasure.
fantastic episode as usual, and as always. And hope to see you on here again soon.
See you soon. Take care.
Thanks.